Good morning, everyone. My name is Jeff Stauffer, Community Relations Director with Elville and Associates, and welcome to our webinar. A new topic today, how to handle the IRS, what to do and not do, presented by Charles Borek, Special Counsel to Elville and Associates and founder of the Borek Group, LLC. So how this will work today, if you're new to our webinars, if you are, welcome. We are glad you're here. You are in listen-only mode. However, if you have questions, please do post them throughout the presentation in the questions panel on the right-hand portion of your screen, and I, as the moderator, will send them to Chuck throughout the presentation. You also received the slides by email yesterday afternoon from me for your convenience to take notes on them if you wish. Everyone will also receive a brief post-webinar feedback email right after the presentation. And we ask that you please do take just a couple minutes to fill out this simple survey to offer us your feedback about the presentation. For certified financial planners, CPAs, and other professionals on today's webinar, you may receive 1.5 continuing education hours for attending. So if I do not have it already, for my records requirements, please email me your board ID, and specifically for CFPs only, I need the last 4 digits of your social security number as soon as possible. So I'd like to give a warm welcome to our presenter today, Mr. Chuck Borek. Chuck is Special Counsel to Elville and Associates and the founder of the Borek Group, LLC. He is a business and tax attorney with almost 30 years of experience representing individuals, small businesses, and nonprofits. Chuck earned his joint JD and MBA summa cum laude from the University of Baltimore, where he was the editor-in-chief of the Law Review and the recipient of the 1993 Law Faculty Award. He has taught law students as a visiting professor and adjunct professor of law at American University and the University of Baltimore, and has lectured at Dickinson Law School of Penn State University. Chuck has written for Thomson Reuters, Bloomberg BNA, and the American Institute of Certified Public Accountants. His book on contract drafting is used by lawyers throughout Maryland and has been cited by the Maryland courts. Additionally, Chuck presents seminars to CPAs and lawyers around the country through his company, the Borek Group, including presentations to Big Four accounting firms and Fortune 500 companies. He lives with his wife, the youngest of his 4 children, and 2 dogs in Howard County, and is currently pursuing graduate work in theology and literature at Wesley Theological Seminary in Washington, D.C. So everyone, you're in very good hands today. We've had Chuck present a number of times here at our webinar series, and we appreciate you being here today, Chuck. So I'll turn it over to you.
Great, thank you very much, Jeff. And welcome to our webinar today, which is on everybody's favorite topic, the IRS. So we're going to talk about a lot of things today. We're going to talk about how the IRS functions, what you need to know in order to understand communications, correspondence in particular, that you may get from the IRS. We'll look at different forms of correspondence that they send out and what those different things mean, and maybe even more importantly, what they don't mean. And we'll talk about how to handle them. We'll talk about different audits and some specific issues that frequently come up in audits. So I want to start out just by talking about the basic structure, the basic background of how the IRS operates in terms of applying a tax liability to taxpayers. And that all centers around this concept of assessment. Assessment is the watershed event when it comes to interactions between taxpayers and the IRS. It's important to understand that an assessment is an actual event. It's a physical event. Assessment happens when the IRS literally signs, an official at the IRS signs a document that states that you have a specific tax liability. Now, they don't sign it individually for each taxpayer. You know, they do these computer runs that have thousands and thousands of taxpayers, and they sign those. But until that event happens, until that document has been signed, there is no assessment. Now, in terms of thinking about the interactions with the IRS, the best way to think about it, I think, is to consider what happens before and after an assessment. So before assessment, we have taxable events, right? We live our lives. We buy things. We spend money that may or may not be deductible, right? We get income that may or may not be taxable. But all these different taxable events happen. At some point, there will be an assessment. And we're going to talk about the various different ways an assessment may occur in just a minute. But at some point, an assessment occurs. And the assessment means you have a legal obligation to pay that tax liability. That's why assessment's so important. You don't have any legal obligation. There may be a proposed assessment. The IRS might take the position that you owe them money, but unless and until an assessment occurs, you don't owe the IRS anything. All right. On the flip side, once that assessment takes place, you have a legal obligation to pay the IRS. An assessment functions the same basically as a judgment in a court of law, right? You have an official legal obligation to pay once the assessment occurs. Whether that amount is right or wrong or partially right, it doesn't matter. Once the assessment happens, that's a legal status. And that legal status is that you owe the IRS money under the law. Now, once the assessment actually does occur, then we get into the backside, or maybe what you would call the dark side of assessment. That's collections, right? Once you're in collections, there's no longer any issue of whether you owe the money. You owe the money by virtue of the assessment. The collections function at the IRS is solely focused on how the IRS is going to get its money, whether you're going to pay in installments or whether there's, if you don't have resources, there's a process known as an offer in compromise, right? We're not going to talk in too much detail about that today. I do want to mention one thing though, because I think if you watch any television, you'll see commercials occasionally about the offer and compromise program. And I think a lot of people are misled by some of those commercials. The offer and compromise program is essentially a bankruptcy just for taxes. All right, it's a bankruptcy that doesn't affect anything else, but it affects your tax liability. Well, just like with bankruptcy, if you know anything about bankruptcy, if you file a bankruptcy petition, it's not like you just go into court and say, I don't want to pay my creditors, and they say, okay, great, you're off the hook. You have to basically give all of your assets to the bankruptcy estate, right? And those assets are used to pay your creditors. And then once you've gotten rid of everything you own, basically, right, with some exceptions, then whatever's left over, you're discharged from. And that's kind of how the offer and compromise program works too. You essentially have to, you first of all have to give all sorts of financial information to the IRS, and then you have to pay them everything you can pay them based on what your assets and what your income is. And once you've paid them everything you could possibly pay them, right? And again, there are some exceptions and exclusions, but basically once you've given all the disposable assets you have to the IRS, then your tax debt is forgiven. So it's not a situation where, they're just giving you a gift and saying, well, if you ask us, we'll just forgive your tax debt. It doesn't work that way. There's pain involved, right? You have to pay it. Now, there are situations, of course, where people are truly insolvent. They just don't have assets to pay. Well, that's where an offer and compromise can be very valuable, because it gets them off your back. The tax liability goes away, and you can start fresh. In fact, on some of these commercials, they even refer to what the IRS sometimes calls the Fresh Start Initiative. But just be aware that the Fresh Start comes only after you've purged yourself of all your resources. All right, so let's talk about how assessment happens. Now, assessment, it just doesn't happen magically. There's lots of different ways to get to assessment. And I want to look at two basic situations, right? You've either filed a tax return or you haven't filed a tax return, right? Now, we can get to assessment in either of those cases, but the path to assessment is depending on whether you filed a return or not filed a return. The most common path to assessment when you file a return is what's called the self-assessment. The law says whatever number you put on your tax return as your tax liability, right? There's a line on the 1040, and I don't know what the line number is anymore, because they changed the 1040 a couple of years ago, and I haven't gotten used to the different, how it's set up. But whatever line it is on that 1040 that says tax liability, whatever number you put in there, the IRS has the legal authority to assess you that amount. Whether it's right or wrong, it doesn't matter. The number that you put in there, you are going to be automatically assessed for. They don't have to ask your permission. They don't have to give you a notice. By virtue of putting a number on your tax return, you are assessed for that amount. All right, that's called a self-assessment. There's another method of assessment if you filed a return, and that's called a summary assessment. Now, summary assessments most commonly occur because of what is referred to as a clerical or math error. So in other words, if from the face of your return, without doing any other investigation, from just looking at your return, the IRS can tell that the number you put on your tax liability line is wrong. You know, maybe it's literally just a simple math error, right? You add things up wrong, or if you fail to put, back in the olden days when we used to have dependency exemptions, right? We don't have those now until 2026 at least. But back in those days when you had dependency exemptions, you had to put the Social Security number of your dependent. So if you failed to do that, that would be considered a clerical error, and they wouldn't give you the exemption for that dependent. And the key with the summary assessments is the IRS can change the assessment. They can change your self-assessment without notifying you in advance. Now, they do have to notify you, but they only notify you after they've done it. So if they make a summary assessment, you'll get a notice saying, look, we got your return and we've changed the tax on it because there was a clerical or math error. And the important thing to understand about that is if you get a summary assessment, that's not necessarily the end of the story. You can object to the summary assessment. And if you object to the summary assessment, and there's no form for this, you simply write the IRS back saying, no, I want the summary assessment abated, right? That's the technical term, abate. They want the summary assessment abated, then they have to abate it. The law says they must abate it. Now, of course, that doesn't mean that you're necessarily out of the woods, right? Because they have other options to get that additional assessment. I'll come back to those in a minute. The third main type of assessment that you can get if you filed a return is something called a Jeopardy assessment. Now, this is fairly unusual. This is generally used in conjunction with a criminal investigation. What a Jeopardy assessment is a situation where the IRS can immediately assess a tax liability, and they can do that if they have information that the taxpayer is about to remove assets from the U.S. As I said, where this most commonly comes up is when they're doing an investigation like with a drug dealer, and they believe the drug dealer is about to take all their assets and, you know, go offshore someplace where they won't be able to get them, they won't be able to get the assets. So in order to avoid that, the IRS can do a Jeopardy assessment, make an immediate assessment, and that way attach the assets before they leave the U.S. And then they have to go through a process, of course, of proving what the liability is. But that's what a Jeopardy assessment is. So back to our chart. What if you don't file a return? Well, there's something similar to a Jeopardy assessment called a termination. It's basically the same thing, but in this case, no return's been filed. So with a termination, what the IRS does is close the tax year. So no matter what, you know, when it is during the tax year, if they believe that you owe tax liability and you're about to abscond with all of your assets, they can immediately close the tax year and assess you at that amount so that they can go after those assets and try to get them before you leave the country with them. Again, these are both unusual remedies, and they're typically invoked when there's criminal activity, when there's a criminal investigation that's ongoing. All right, so let's look at some more normal, more common types of ways to assess it. As I said, with a summary assessment, you can easily have it abated, right? You just send a letter saying, I want my summary assessment abated. But that's, as I said, not the only way they can make the assessment. If you filed a return, one of the things that you may get is a letter that's known as a CP2000 letter. All of the IRS letters generally are form letters, and they're typically designated by a number. This particular letter that I want to talk about is a CP2000 letter. I'm going to show you what a CP2000 letter looks like in a few minutes. This letter is, in my opinion, probably the most misunderstood piece of correspondence the IRS sends out. Because as we'll see when we actually look at the CP2000 notice, it looks like the IRS is saying you owe them money. But in fact, you don't. Look at my chart on the screen. Remember what I said earlier. You don't owe the IRS anything until there's been an assessment. Well, a CP2000 notice can come from a return that's been filed, but you'll notice there's no line connecting that CP2000 box and assessment, right? So there's no assessment has been made yet. All the CP2000 notice is really saying is that, look, we got your return, but your return doesn't match other information we received. In other words, most commonly what happens is the IRS has 1099s that have been filed that show more income than you're showing on your return. Or it could even be something that could be a W. But in any event, the CP2000 notice just says, look, your return doesn't match the information we have. Now, the procedure you should take at that point is to clear up whatever the problem is. And so it could very well be that a 1099 was sent to you in error or had the wrong number on it, or there's any of a number of reasons why what the IRS got might be legitimately different from what you got. And so you can contact the IRS and you can clear that up at this point. Remember, no assessment's been made yet. Now, if you don't clear it up, if you don't provide any information, then the IRS can get to assessment, but they have to get to assessment through what's called a deficiency procedure. And that deficiency procedure involves sending out what's called a 90-day notice, sometimes referred to as a stat notice or statutory notice of deficiency. This is a legal requirement. Before the IRS can assess you any tax liability based on a CP2000, they must send you this 90-day letter. Now, a 90-day letter, you'll usually, be able to tell that it's a 90-day letter because it typically says 90-day letter or statutory notice of deficiency at the top of the letter. The reason it's called a 90-day letter is because once you get that letter, you have 90 days to file a tax court petition. Right? There's a special court, federal court called the tax court, where you're allowed to contest a proposed assessment before the assessment takes place. All right, it's the only place, in fact, the only court that you can contest an assessment before the assessment actually takes place. So the tax court's very special. We'll talk a little bit more about that later. But that 90-day notice is both the notice to you that you have only 90 days to file a tax court petition. After that 90 days runs, you've lost that right. It's also your ticket to tax court because, in fact, you can't file a tax court petition unless and until you've gotten a 90-day notice, a statutory notice of deficiency. All right. So they send you the 90-day notice. If you don't file a tax court petition, or if you file a tax court petition and you lose in tax court, then of course that leads to an assessment. And remember, at the assessment, that's when you actually owe the tax liability. Of course, the other way we can get to assessment if you file the return is you can be audited, right? What the IRS refers to as an exam. You can be audited after the audit, and we'll talk more about the details of an audit in a few minutes. But typically at the conclusion of an audit, they generally send you what's called a 30-day letter. And that just gives you 30 days to essentially contest the auditor's findings with the auditor's manager. It's an internal review, basically. And if it's not resolved at that point, then they have to send you that 90-day notice or that statutory notice of deficiency. And then, of course, you have the same thing. You can either file a tax court petition, or if you don't, you'll be assessed. Right. So you might say, well, gee, I can see an easy way out of this. What if I just don't file a return? If I don't file a return and I'm not a criminal, I'm not going to get a termination assessment. So, it looks from what's on the screen right now that maybe that gives you a get out of jail free card. Well, of course, as you probably suspect, it doesn't, because if you don't file a return, the IRS can file one for you. It's called an SFR, or substitute for return. And what the IRS does is they take the information they have, again, from 1099s or W-2s, and they file a return on that basis. They don't give you any deductions, right, because they don't know what your deductions are. So basically, it's just your income. They give you the standard deduction, and then whatever the tax comes out to be, that's what it comes out to be. And then they can use that SFR to send you a 30-day letter. Oftentimes with the SFR, however, they don't even send a 30-day letter out. They don't have to do that statutorily, but they do have to statutorily send out the 90-day letter. So oftentimes they'll just do the SFR and send you a 90-day letter right away. Okay. Again, the SFR, it comes from the tax code itself. There's a provision in the tax code, section 6020B, that gives the IRS the authority to do this. Again, the IRS executes the return. They do have to give you an opportunity for a hearing before assessment, which means they have to send you that 90-day letter, right? They can't just automatically assess you. But most importantly, if an SFR is filed, it doesn't start the statute of limitations for an exam, meaning that the statute of limitations, which is generally 3 years from the date you file a return, that never starts to run. So they can file an SFR on you, make an assessment, and they can still audit you for that year. So that's the main reason that if you fail to file a return and the IRS has filed an SFR, in almost every circumstance, the recommendation is that you then file your own return. First of all, that might clear up the SFR. The SFR may show that you owe a tax liability, and maybe in fact you don't owe a tax liability. If you simply file your own return, that might rectify the situation. And secondly, once you file your return, that starts the statute of limitation running on assessment. The specific statute of limitations is the IRS has 3 years from the date you file the return or the due date of the return, whichever is later. So in other words, if you file your return early, right, your return's generally due on April 15th. And if you file your return in February, the IRS doesn't have 3 years from February, they have 3 years from April. Right, so it's the later of when you file your return, the return is due. Note, by the way, in case you haven't heard, the IRS has extended the due date of returns this year to May 17th. So you don't have to file your returns until May 17th. However, one thing that you should note that I think a lot of people are missing is if you pay quarterly estimated taxes, the first quarter's estimated taxes are due on April 15th. Now, normally you're used to filing your tax return and, or at least the due date of your tax return and the due date of the payment of the first quarterly estimated tax on the same day, April 15th. They extended the due date of the tax return this year, but they did not change the date you have to pay the quarterly estimated taxes. So you still, if you're a quarterly estimated taxpayer, which generally means your wages are from something other than W-2s, then you have to still make that payment by April 15th. All right, and that's for 2021, right? The April 15th payment is for your current year's taxes. The tax return, of course, is the 2020 tax return. That's not due until May 17th. I have a question. The question is, do Maryland residents have to file income tax returns in Delaware and Virginia if they have rental houses in those states? Generally, yes. Each state has its own rules as to when you have to file a tax return in that state. You start out with the basic premise that if you earn any income in a state, then generally you have to file a tax return in that state and pay taxes to that state. Now, having said that, states have different exemptions, right? And so sometimes if we're talking about business income, for example, typically the state doesn't make you file a state return until your business income is above a certain amount. Whether or not you'd specifically have to file a Virginia return or a Delaware return for rental income, I'd want to look at the Delaware and Virginia rules to be sure. But you should start out with the presumption that yes, you would have to file a Delaware or Virginia return to pay tax, Delaware or Virginia tax on that rental income. Now, whenever you do that, by the way, you generally get a credit in your home state, so you don't pay the taxes on the same income twice. So if you have to pay taxes to Delaware or Virginia, then you you don't have to, generally you're not going to have to pay the same tax in Maryland. All right. All right, so let's talk about the selection of returns for examination. This is a question that I get a lot. Very frequently, I do a lot of tax planning where we put together business deals and start businesses and things like that. And oftentimes my clients will ask me if there's something specifically that we're doing that will trigger a tax return or a tax audit. And I will tell you that the general answer to that is no. And what I mean by that is generally no one thing is going to trigger an audit, right? That's kind of an urban legend. There really are not things that will trigger an audit. It's not as if the IRS has a list of things, and if you do one of them, that puts you into the audit category. That's not how it works. I'm going to tell you about how it does work and how they select returns for audit momentarily, right? But one thing won't generally trigger an audit. What I oftentimes say to the CPAs that I'm training in this regard is I say, look, if on the signature block of the return you write, screw you, and you don't sign it, that might trigger an audit. But other than that, there's generally not one single thing that will trigger an audit. So let's talk about how they do select audits. There is a very specific selection process. They don't select audits. They don't select returns for audit randomly. All right. They have a very specific procedure they use to select returns for audit. Their main objective is to promote voluntary compliance. Let me tell you what I mean by that. The vast majority of returns do not get selected for audit. The IRS only audits a very tiny fraction, generally less than 1% of returns overall, right? Very, very few returns ever get selected for audit. Now, I know it feels like if you've been audited, you think, well, gee, once I'm audited, I feel like every return's audited. But the fact of the matter is, you probably, I don't know what the specific statistics are, but you're probably more likely to win the lottery, frankly, at least the scratch-off lottery, than you are to get audited, right? Very, very small percentage of returns. They audit returns primarily to promote voluntary compliance. The idea is that, well, you don't know if you will be audited. And since they do audit returns, and everybody knows that people do get audited, and you don't know if you're going to get audited, that encourages you to not cheat on your taxes, right? Because if you do get audited, you don't want to get in trouble. The selection process at the IRS is known as the process of classification. The IRS, since audits are designed to encourage voluntary compliance, the IRS has an incentive to select returns for audit that are likely to have adjustments, right? When the IRS does an audit and there are no adjustments, turns out you did everything perfectly fine and you had all the substantiation you needed, that's kind of a waste of time for the IRS. Not because the IRS gets a commission or anything like that, but because it really doesn't have any, they can't use it as an example, right? What they want audits to be is they want them to be examples. They want all your friends and relatives to know, hey, look, I got audited, I didn't do something right, and then I had to pay more tax and penalties and things like that. They want that word to get around, right? So if they do a lot of audits and there isn't any change, well, people have sort of the dangers that people have the opposite impression, right? You get audited and there's no change. So the IRS, they can never have a perfect selection process, right? They're always going to pick some returns that just don't have any changes on them, but they want to minimize that. They want to pick audits for return that are most likely to have changes. So when they classify, and that's the process, that's what they call the process classification. IRS employees will spend time, typically on a rotational basis. It's not the same employees do it all the time, but they will rotate into this classification assignment where they have to classify returns. When they classify returns, what do they look for? Well, they're looking for exam potential. In other words, they're looking to see if there are things on the return that look like they might give rise to an adjustment, things that are out of the ordinary. Very large charitable contributions in comparison with the income that's reported on the return, or very low income, that seems like it wouldn't support the person, and again, that depends on all the other aspects of the return, right? So if you have a married filing joint return, then that's the return for both people in the married couple. If they're not reporting much income, well, presumably there's no other income unless somebody else is supporting them. So they look at things like that. Business income is always going to generate their curiosity, and they're going to look to see if the business income looks reasonable. Once they do that, they have to identify specific areas for consideration. When the IRS audits your return, they don't audit everything. They don't audit from A to Z, right? They don't audit everything on the return. They pick specific issues. Let me pause for a minute. Having said that, they do occasionally do audits where they examine the entire return, but that's for statistical purposes. They do that to gather information, right? That's a separate program. That's not a regular audit. But in a regular audit, they're going to classify. They're going to classify the return, and they're going to select specific items for consideration, decide what the scope of the exam should be. When they do the classification process, of course, sometimes they don't see anything unusual, and they say, well, we don't really think there's any likelihood, any substantial likelihood, at least, of an adjustment here. So we're just going to leave this one alone. And when that happens, by the way, you never know, because the IRS does not alert you to the fact that your tax return went through the classification process. So you may very well have had returns that went through the classification process, and if they didn't select it for exam, then you would have no way of knowing about it. Sometimes they don't examine returns because they just don't have the resources to do it. The IRS, as a federal agency, has really been struggling over the last few years. Its budget has not kept up with inflation. In fact, its budget had been cut for several years in the past 10 years or so. For several years running, the IRS budget has been cut. They've had to do more with less resources. They've had a huge decrease in their personnel. The IRS has lost about 25% of its staff over the last about 15 years. The IRS is actually about 25% smaller than it was 15 or 20 years ago. A lot of that's through retirements, and for much of the past several years, the IRS has had hiring freezes in place. So when people retired, they couldn't replace them. Of course, sometimes people just leave the IRS. Oftentimes people work for the IRS for a few years and then move on to the private sector. And so the IRS is in a bit of chaos in that respect. And so sometimes they just can't do an exam because they just don't have the resources to do it. Now, in terms of the actual selection process, how do they decide which returns are actually going to classify? Which returns are they even going to look at? Most of the time, it's done through what's called a Diff Score, discriminant function score. That's what Diff Score stands for. That's a mathematical technique. The Diff Score weighs certain basic return characteristics. It's not disclosed. The formula they use, by the way, is not disclosed to anybody, even in the IRS, except those who absolutely need to know. So when somebody tells you they can, tell you what your Diff Score is going to be or how your Diff Score is going to be calculated, they're lying to you, because nobody knows, except literally it's like the secret formula for Coca-Cola, right? Only a few people know it, and that's it. I know lots of people that work for the IRS. Many relatively high up officials at the IRS, and I will tell you, none of them knows what the Diff Score is or the Diff Score formula. All right, there are a few things we know, right? There are some things we can just from experience tell. First of all, we know that the way the Diff Score works, the higher the score is, the more likely they're going to select you for audit. After every return that gets filed, they calculate the Diff Score on. And then they establish a cutoff, and they say, all right, all the returns over this specific Diff Score we're going to look at. We're going to put through the classification process. The Diff Score itself mathematically looks something like this. Of course, I'm joking, right? The whole point is nobody knows what the Diff Score is. It's literally a complicated mathematical algorithm. Now, there are some things we can guess, right? So we know, for example, if you have very little income but a huge amount of charitable contributions, we know that's going to raise your Diff Score, right? We don't know exactly by how much, right? But we can tell simply because returns like that, returns that have charitable contributions that seem out of whack in accordance with the income that's reported, they seem to get audited a lot. So that must be raising the Diff Score. But that's really, even, although it's a pretty good educated guess, it is still a guess, right? So be wary of anybody who tells you that they can tell you whether you're going to be audited based on what your return says. It doesn't work that way. Right? So that's the main way they select returns for audit. Of course, they select returns for audit in other ways as well. Informants. Informants are often people like, oh, I don't know, disgruntled former employees. Right? You have an employee working for you, and the employee knows that you're cheating on your taxes. The employee knows that you're not reporting all your income, for example. You may be foolish enough to involve your employees and fudging the records or taking money out of the cash register and not reporting it or something. Well, then what sometimes comes to pass, of course, is you have a run-in. The employee has a run-in with you. They don't like you anymore. They're mad at you. They think you've screwed them in some way. And they say, I think I'll tell the IRS, what my employer was doing. And so that happens sometimes. And not every tip that the IRS gets are they going to necessarily act on, but sometimes they will open an audit because of informants. And then finally, the document matching program. This goes back to that CP2000 letter. If the documents that have been filed with the IRS, again, meaning things like 1099s and W-2s, if they don't match what's on your return, that could trigger an audit, okay? But those are the basic ways in which the IRS selects returns for audit. Remember that, as I said, when they select a return for audit, it's always going to be limited in scope. They decide what type of examination to perform, and I'm going to tell you about the different types in just a second. And they also identify the issues, all right? So there will always be specific issues. They're not going to look at everything on the return. They might just be looking at your charitable contributions. They might just be looking at your income. They might just be looking at your business deductions. And even then, they won't, generally, they're not going to look at all your business deductions. They'll look at specific ones. So let's talk about the nitty-gritty of audits and what you should know about how the audit process works. And to begin with, what you should know about who the auditors are, right? There's 3 different types of auditors, right? There are tax examiners, there are tax compliance officers, and there are revenue agents. If you're being audited, the first thing you should find out, first thing you should figure out is what type of auditor is auditing you, because these 3 different types of auditors do very different types of audits, and they have very different types of backgrounds. So I'm going to look at all 3 of these and tell you who they are and what they do. First of all, tax examiners. Tax examiners only do correspondence audits, meaning you never see a tax examiner. You might speak to them on the phone. They work from the IRS Service Center campuses, so they might be anywhere, right? You might get a correspondence audit, I should say, from a tax examiner in, California. They don't have to be local to you. Usually you have very little and sometimes no direct contact, meaning that you just do everything by correspondence. Note that the tax examiners is an entry-level position. The educational requirement for a tax examiner is a high school diploma or GED. So these are not CPAs you're dealing with, right? They're basically, it's an entry-level position. They have form documents, form letters they send you that ask for certain things. When you send them stuff back, they check off on their list whether you sent the right things back or not, and then they issue a letter that concludes the examination. All right. So these are sort of the lowest level examinations you have at the IRS, from tax examiners doing correspondence exams. Tax compliance officers conduct what are known as office audits. Now, office audits are those audits where you have to go to the IRS, right? So if the IRS contacts you and says, we want you to come down to the IRS office and bring all your tax documents, that's an office audit. Tax compliance officers, they don't leave the office. They don't do audits anywhere outside of the IRS offices. They do have to have some college, but they only have to have 6 college credits in accounting. So again, these are not necessarily CPAs. They might be CPAs, by the way. These are the minimum requirements, of course, right? So I actually have met once a tax compliance officer who was a CPA, but that's pretty unusual. All they have to have basically is 6 hours of accounting at the college level. They go through 10 weeks of classroom training and then 40 weeks of on-the-job training. So they're definitely a little higher up than the tax examiners. They know a little bit more about what they're doing. They handle issues that are a little bit more complicated. All right, but again, these are not CPAs. These are not the most highly trained auditors. The most highly trained auditors are what are called revenue agents. Now, revenue agents only conduct field audits. Revenue agents come to you, all right, or to your business or to your representative. We'll talk about that in a minute. They have to have a bachelor's degree with a minimum of 30 credits in accounting. So they basically have to have a bachelor's degree with a major in accounting. Most of them are not CPAs, but some of them are. And they are specifically trained in different areas. They're specifically trained with respect to fraud issues. And oftentimes they specialize in certain industries. So, you know, there may be a group of revenue agents who only work on restaurants, or a group of revenue agents who only work on high-income individuals and things like that. All right. So they are the most highly trained, and those are typically the auditors that handle the most complicated issues. You should also know that auditors are allowed to work flexi-place, generally speaking. And that's an important thing to know as a practical matter. Now, let me tell you what that means. That means that even before COVID, revenue agents generally are allowed to work out of their home. Now, the reason for that is, generally speaking, the revenue agents are supposed to be, you know, at the taxpayer's location. But when they after they gather information from the taxpayer and they sit down to actually, you know, put together the audit, they don't go to the IRS office. They go back home. The reason that's important to know is because what I find in my practice is oftentimes the revenue agent will want just loads of copies of stuff that they can just go back and sort of at their leisure, you know, at their dining room table, kind of leaf through. And I don't allow that to happen, right? I don't want the auditor to be sitting in their pajamas watching TV as they're going through your tax information. And they're not really allowed to do that, right? Audits, field audits are supposed to be done in the field. All right. You know, obviously they may have copies of things and make all sorts of work papers that they take back with them to analyze. But when an auditor, which happens frequently in my experience, comes and just says, look, I don't have to bother you all day. I don't have to sit here all day. Just give me all your stuff. You know, give me copies of all your papers, and I'm just going to take them with me, and I'll get back to you. My answer to that is always no. I don't think that's in the best interest of the taxpayer. And I'll have more to say about that in just a few minutes. Well, let's talk about those 3 different types of audits I mentioned, right? I said tax examiners do correspondence audits. How do you know you're getting a correspondence audit? Well, correspondence audits frequently start with the CP2000 notice. Remember, I said this is the most misunderstood notice the IRS sends out, and I would show you what it looks like. This is what it looks like. Now, this one's a little older. This is refers to a 2006 tax charging C. But notice what it says in big, bold letters about 3/4 of the way down there. Amount due. Amount due. It looks like a bill, doesn't it? And that's what most taxpayers think it is. They think the IRS is saying, in fact, that's usually what they say to me when they call me. They say, I just got a bill from the IRS. The IRS is billing me, in this case, $2,289. But read what the sort of the small print underneath that says, right? says the income and payment information we have on file from sources such as employers, financial institutions, doesn't match the information you reported on your return. If our information is correct, you owe us $2,289. All right. So this is not a tax bill. This is just saying their information is different from yours. Remember, they cannot assess you anything until after you get that 90-day letter. So even if you don't respond to this, the next thing that you have to get before you owe any money is the 90-day letter. Let me make a comment about that too. I say you have to get it. Let me be more accurate about that. The IRS has to send it to you. They generally send it to you certified mail. Some taxpayers are under the mistaken assumption that if they simply don't open the IRS mail or they don't sign for the certified letter, then they've never gotten the 90-day letter and they're off the hook. It doesn't work that way. The IRS only has to send it to your last known address. If you never pick it up, if you don't open it up, if you don't sign for it, that's your problem. It doesn't mean you haven't gotten it from a legal standpoint. And that brings me to one of the prime rules that you should live by, which is that you should always open mail from the IRS. You are never advantaged by not getting information from the IRS or pretending you haven't gotten information from the IRS. If you get a letter from the IRS and you ignore it, or you don't open it, or you don't sign for the certified mail, all that means is the IRS knows what's going on and you don't. It puts you at a disadvantage, all right? So never ever neglect to sign for a certified letter from the IRS or to open up mail from the IRS. You're never advantaged by ignoring that. Okay. Now, oftentimes, instead of the CP2000 notice, you might just get a correspondence audit notice without getting a CP2000 notice. And that generally comes in the form of letter 566. And as you can see, it simply says, we're auditing your return. And then there's all these check boxes, right? So as I said, the same is true with correspondence audits as is with field audits. The IRS doesn't audit everything on your return, right? They audit specific things. And so they'll check off what they're auditing. So in this example, they're auditing your Schedule A, your medical and dental expenses, your gifts to charity, your unreimbursed employee expenses, and other miscellaneous deductions. That's it. That's all they're interested in. All right. Well, what do you do if you get such a notice? We have to respond to it. You respond to it, by correspondence. Again, this is not you're not talking to the tax examiner, right? You're going to do everything through the mail. The key is you want to give a detailed explanation for each issue and attach the supporting documents. This is one of those things where neatness kind of counts, right? If you want to get through this correspondence audit as quickly and as painlessly as possible, just make sure that you're giving them a response to everything they've asked, and you give them supporting documentation. I literally, when I do this for clients, will sometimes actually make up a binder, right, with tabs in it, and say, all right, well, here are the 6 things you asked for. I've got 6 tabs. Under each tab, I'll have a short explanation of what it is, followed by the documentation. You make it nice and neat and simple for them. You don't want to just send them an envelope full of receipts and things and let them sift through it. That's not likely to get you the best result. If you have a representative, make sure you tell them who your representative is. Once, by the way, the IRS knows that you have a representative who can be either a lawyer or a CPA, has to be one or the other. But once they know you have a representative, they are prohibited from talking directly to you. So if you have a representative, if you have a lawyer or a CPA and you want them to handle it, tell the IRS that there's a special power of attorney form you'll sign that the representative will file with the IRS. And from that point forward, the IRS should only be dealing with that representative. All right. So the point is, with a correspondence audit, you simply have to respond to it, and you respond to it completely. All right. What about office audits? Well, with an office audit, remember, this is the type of audit where they call you into the office. This is what a tax compliance officer does. Typically, and there are different letters, by the way, but this is the most common one. This is letter 2202. And the way you know it's an office audit is, as you can see sort of in the middle of this letter, they give you appointment information. Now, they always give you appointment information because the IRS knows that if they send you a letter that says, we want to do an audit of you, contact us to schedule an appointment, they know that most taxpayers will never contact them, right? So they sort of get the ball rolling. They always have a date and a time for your appointment. Now, you can change that readily. They'll be happy to change that for you. They want it to sound like this is significant, that you have this appointment that you have to show up to, because they want you to take it seriously, but they will readily change it for you, all right? I've been practicing for 30 years, and I don't think I've ever had a taxpayer actually attend the office audit at the date and time specified in the letter. We always contact. Now, you got to contact them. You don't want to just not show up, but you contact them and say, look, I can't do it until whatever. And again, they'll be reasonable. They're not going to give you like another 10 months, but if you need another 30 days or 60 days, they're generally pretty flexible. Again, the whole point of the appointment information is just to get you to respond, basically. All right. With office audits, again, you want to contact them immediately. You would call them, right? There's always going to be a number and a contact person on that letter. You call them, or have your representative call them if you're represented by an attorney or a CPA. Just like with the correspondence audits, neatness counts, right? You want to prepare and organize. You want to start getting your documents together. You don't have to make copies for the tax compliance auditor, tax compliance officer, I should say. This is again a very common misunderstanding that people often have. You're never required to give copies of anything to the IRS. The IRS is supposed to look at, except in a correspondence audit, of course, because you got to send them stuff. The tax compliance officer or the revenue agent in a field audit is supposed to look at what you have. They might ask you to make copies for them as a, but you never have to. As I said, the auditor will come in and say, well, I just want you to copy everything for me so I have a copy of everything. I never do that, right? I might make copies for them of things that are helpful to my client, things that I want them to have copies of, but I'll never make a wholesale copies. Whenever they say that, I just say, well, if there are specific things you want copied, let me know and we'll consider that, but I'm not just going to copy everything for you. The question that I'm often asked, of course, is should I have a representative? And this is kind of hard to answer because obviously I'm an attorney and I'm an attorney that represents taxpayers. And so it's hard to answer it without sounding self-serving, right? But the answer is yes. I think, sometimes, you may not want to spend the money to have a representative. That's sort of a cost-benefit analysis you have to go through. But I think every taxpayer is always better with a representative. Folks like myself who represent taxpayers before the IRS all the time, we sort of have a feel for these things, right? It's just like anything else you do a lot. If you're a taxpayer being audited, it's probably the first time in your life you've been audited, or maybe if you're really unlucky, maybe you've been audited once or twice before at the most. Whereas folks who are in my business, we do it on a regular basis. And so I think it's generally better to have representation. Again, I understand if you have, a possible adjustment of $500, you don't want to spend $10,000 on an attorney to represent you for that. I get that. But if you ask me, is it better to have a representative than not have one? The honest answer is it's better to have a representative. It doesn't mean you're going to have a terrible outcome if you don't, but it's always better to have one. Note, by the way, that the tax compliance auditor can never require you to come to the audit. Now, there are certain very rare circumstances where they can issue an administrative summons so that you are physically at the audit, but that's rare, right? The law in tax code section 7521C specifically says that generally speaking, they cannot require your presence. You can send your attorney or your CPA and you don't have to go. So one of the benefits, frankly, of having a representative, audits tend to make people nervous. I certainly understand that. If you have a representative, you can send them and you don't have to deal with it at all. And the question is there any penalty if you file your income tax by May 17 this year and don't know your estimated tax you would pay on your 1040 ES form for the April 17th payment until you complete your income tax? So I would be sending it a month later for the April payment. Remember, your quarterly estimated tax is always sort of a guess. There are safe harbors, right? If you pay in the full amount of your tax liability for the previous year, or 110% of your tax liability for the previous year, depending on your income level, that's a safe harbor where they won't give you a estimated tax penalty. So you will still currently, unless they decide to extend in the next couple of weeks the due date for the quarterly taxes, you will get an estimated tax penalty, your first quarterly estimated tax amount by April 15th or April 17th. Maybe the 15th falls on a Saturday, I don't know. But in any event, if you don't pay on time, you will get an estimated tax penalty. That's not the biggest penalty in the world, so you may decide you're just going to eat that, and you'll wait until May to figure out what the amounts should be, or to be safe, you probably try to make a guesstimate of what it would be and send that amount in. Remember, not only are you required to pay each quarterly's estimated tax payment, but it's required to be correct. So if you pay less than you should have paid, you're still going to get a penalty. So a recommendation would be to send in something, send in what you think it's probably going to be. And then if it turns out to be too little, you'll get hit with a little bit of a penalty, but it won't be as big a penalty if you don't pay, as if you didn't pay anything at all. All right, another question here. Statement by a financial advisor we have. Wrong. You may be represented by a CPA, lawyer, or enrolled agent. EAs have the same representation rights. That's correct. Enrolled agents, that is correct. Enrolled agent is somebody who is neither a CPA nor a lawyer. The difference is an enrolled agent can only represent you in the audit. They can only represent you with respect to the tax return that's at issue. They can't represent you with respect to other issues. But that is correct. Enrolled agents have to take a special examination by the IRS. And then they have to take continuing professional education credits every year. But I stand corrected. You are absolutely right. Attorneys, CPA, or enrolled agents can represent you. All right. Field audits. All right. So we talked about correspondence audits, talked about office audits. Let's talk about field audits. Remember, these are the ones done by revenue agents. Typically, a field audit starts with a letter like this, letter 2205. It tells you, and this will actually come from the revenue agent who's going to do your audit. It'll ask you to call them because they want to sort of set the ground rule of the audit. They'll be specific about the items on their return that they're going to be examining and the kinds of documents. They'll tell you about the exam process. They'll address any concerns you have. What I said earlier about having a representative, I would emphasize even more with a field audit. Right? If you're having a field audit, if a revenue agent is doing your audit, and they only do these for business audits, by the way. Generally speaking, except for high wealth individuals, revenue agents don't audit your run-of-the-mill individual return. So there's a lot of negotiation that can go on in a field audit in terms of what the scope of the audit is going to be, what kinds of documents they'll accept and won't accept, things of that nature, how long the process is going to take. And a representative, in my opinion, is much better positioned probably than the taxpayer to negotiate those things. You do want to set the ground rules, this initial contact, and that's really one of my main jobs when I'm representing a taxpayer in a field audit, is to set the ground rules, to know specifically what we have to provide, specifically what kinds of documents they're looking for. When the field auditor, when the revenue agent begins the field audit, I generally, if I'm representing them, I have them come to my office. What I do is I get all of the documents that I need from the client, and I have the revenue agent come to my office. I just think it's dangerous to have them do the audit in your office. There's too many things that can come up that might be confusing and misleading and cause you problems, right? There are other employees in your office, there are customers, there are things, files and things that they might see that might think something is that it's something that it's not. I just don't see any benefit in having them do it in your office. They have no right, by the way, to go to your home. They might ask to do it in your home, but they have no right to go to your home without a warrant. They do have a right to tour the business. Now, sometimes if you're doing business from your home, they'll say, well, gee, we have a right to tour the business and your business is your home. And if that's the case, they're right. They do have a right to tour the business, meaning they can come in, you can show them around, say, this is where I work. Here's where my files are. This is the way I do business. And then they leave. They don't have to do the office in your, the audit in your home. All right. Just like with other audits, you want to be prepared and organized. You want to be cooperative, not adversarial. Too many of my clients, I find, think that the IRS is the enemy. And they are not. I understand why you might think of them that way, but they're not. They're not in the sense that, frankly, although you come across all sorts of people, of course, the vast majority of revenue agents, they don't really care if there's an adjustment to your return, right? They don't get a commission. They don't get any better pay if they find a big adjustment. What they want to do is they want to do their job. They want to do their job, at least competently, so they don't get fired. And they want to go home at 5 o'clock. A lot of taxpayers think that, oh, the revenue agent is, somehow wants to prove a point and wants to try to get a lot of adjustments so they get a big bonus or something. That's really just not true. In fact, it's illegal for the IRS to compensate revenue agents based on how many adjustments they find or how much of an adjustment they find. One thing that you want to do, and this is again a good reason to have a representative, is that you want to note exactly what they're looking at. All right, that's why I never just give the representative or never give the IRS agent just a box of stuff and say go at it. Let me know when you're done. I want to know exactly what they're looking at. When I represent a client in an audit, I literally typically sit with the revenue agent and I just watch what they're doing. By the way, sometimes that makes the revenue agent uncomfortable, and that's too bad, right? Field audits have to be done in the field, and you have a right to be represented, and you have a right to know everything that they're looking at. And you do want to get specific commitments from them. When is, if we're going to have another appointment, sometimes they have to come out more than once. You want to know exactly when that is going to be. How long is it going to be before you're able to do your report? You want to get specific commitments from them. If they're going to agree on an issue, again, you want a specific commitment from them with respect to that agreement. Again, these are things that representatives, attorneys, and CPAs and enrolled agents, they're used to doing these things. And so they're generally better at it than your average taxpayer. Most field audits are done by what's called the SBSE division, Small Business Self-Employed Division. The things that they most commonly look at are things like unreported income. Unreported income is a big one. If there's one piece of advice I can give to you in terms of filing your tax returns, it would be report all of your income, all right? Because that's kind of a slam dunk for the IRS, right? If you have income, you didn't report it, there's really no defense to that. So if you're going to cheat, and I don't suggest you cheat, but if you're going to cheat on deductions, don't cheat on the income. Report all of your income. They're always going to look for that. Other common things that they look at are the home office deduction, if you're taking that, car and truck expenses, depreciation, hobby losses. I'm going to talk more about hobby losses in a minute. Unreimbursed employee expenses, well, we don't really have those anymore, at least not until 2026. And retirement plan deductions, right? Those are things that they commonly look at. All right, and again, they might look at lots of other things too, but those are the most common. One of the things in a field audit you're going to get is an information document request. This is a form 4560 form, and it asks for all the documents they want. It can be very lengthy, and it starts out as basically just a form document. That should be negotiated as well. And again, this is where another instance where you have the advantage of a representative. A representative will know how to negotiate that idea, because typically, at the beginning of an audit, the revenue agent will just ask for everything. And what we do as a representative is and you can do this yourself, but you contact the IRS and you go through that list and say, well, why do you need this? And we negotiate whether there are certain documents they really don't need. And so you want to try to negotiate that IDR down as much as you can. Now, if you just don't respond to the IDR, or if you don't negotiate it and you don't give them something they've asked for, they can issue a summons. So they can force you to give them those documents. The culmination of the audit process is going to be one of four things. It might be a no change, right? That means, as the name implies, there's no change. Nothing is changed on the return. It can be an agreed case, meaning that they've proposed changes and you agree. You say, yeah, I did that wrong, or I didn't have the proper support for that, and I don't have, there's no basis for me to fight it. So you simply agreed. That's what they like, by the way. That's what they want to get an agreed case. That makes it easiest for them. Some cases, of course, are unagreed, where they propose adjustments and you say, no, I don't agree with those adjustments, and so the case goes unagreed. And of course, you can have a partially agreed case, right? You can agree to some things and not agree to others. More commonly, I just let the case go unagreed. I don't go, issue by issue, but that's certainly an option. Unagreed cases, there's a mandatory group manager conference, right? All revenue agents act for a group, work for a group manager. That's how the IRS is arranged. The frontline employees all have a group manager. There is a fast track mediation resolution program. I have not used that much. It's it's available, but it's and the IRS tries to promote it, of course, to resolve these cases, but it's not done very frequently. Then you have the traditional appeal, and I'll have more information to talk to you about that in just a second. You'll always get in an exam report, generally on Form 4549. And this is the actual form, and it lists, as you can see, all the adjustments to income, the total adjustments, and this means they're adding certain things in this case, that they're adding an additional $8,456, that you claimed as a deduction. They're not giving you credit for, contract expenses, etc. This is the self-employment tax adjustment. So they end up with total adjustments, and then they, sorry about that, and then they there we go, and then they calculate the correct liability based on those adjustments. All right. So that form 4549 is crucial because that gives you all the details of the adjustment. That's the form they'll want you to sign if it's an agreed case, right? You literally just sign this form saying, yes, I agree to these changes. There is a form 866A for unagreed cases. And with unagreed cases, there's 6 elements. The revenue agent has to specify the issues, the facts, the law, what the taxpayer's position is, what the government's position is, and their conclusion. So if it's an unagreed case, you're entitled to a little more detailed information. You'll notice on the general revenue agent's report, it just shows what the adjustment is. There's typically a brief description of why those adjustments are made. But on Form 866A, they have to go into more detail about it. Remember I said after an audit, generally you're going to get a 30-day letter. Now, a 30-day letter is not statutorily required. We routinely do it. And so 30-day letter basically says you have 30 days to appeal to the manager, generally speaking, to try to discuss it with another person who hasn't been involved in the audit, a fresh set of eyes. And then if it's not resolved, then you would eventually get a 90-day letter. When you're appealing, by the way, there are different rules as to whether or not it has to be in writing. If the amount that's being proposed as an adjustment exceeds $25,000, then a formal written protest is required. There's no form for that, but there's certain information that the written protest has to contain. If it's less than $25,000, there is a form. It's Form 12203, which basically just says that you're appealing it. You don't have to put a lot of information. It's a pretty streamlined form. Note that S corporations, partnerships, as well as exempt organizations and employee plans always have to file a formal written protest in order to get that appeal from that 30-day letter. Said the written protest has to have certain things in it. These are those things. There has to be a statement that you're appealing, the name, address, telephone number, or a copy of the IRS letter that proposes the changes, the tax period, years involved, a schedule of adjustments that you don't agree with, and then number 6 is the most important thing. You have to identify the facts in the law that support your position, and you have to sign it under penalties of perjury. All right, let's talk about some miscellaneous issues. Before we do, there's another question. Question is, are you able to represent a U.S. citizen who has lived in Australia for over 20 years and hasn't filed a tax return for the same period? Well, yeah, any attorney or CPA, licensed and enrolled agent in the United States can represent that taxpayer before the IRS. All right, so let's talk about some miscellaneous things. Chance of being audited, as I said, really slim chance. Statistically, your overall chance is 0.6% or 1 in 160, but that doesn't include the math error notices, right? Those summary assessments, or the CP2000 notices. The overall audits, now this information is a little dated, it goes to 2017, but you can see that there's been a steady trend downward for both all returns and individual returns. And that's primarily due to the fact that the IRS has fewer resources. We can break down the chances of being audited by your income. So if your adjusted gross income, right, that's what AGI means, is from $500,000 to $1 million, your chances of being audited are 1.56%. Currently, now that's decreased from 2.06% in the past. Between $1 million and $5 million, you have chances of 3.52%. Between $5 million and $10 million, 7.95%. And if your AGI, your adjusted gross income, is over $10 million, your chances of being audited are 14.52%. Now, you might say, gee, that doesn't sound like, these tiny amounts you were talking about earlier. But again, those are percentages, right? If you look at it in terms of the actual number of returns under these different categories, the fact of the matter is the IRS audited 812,000 returns for taxpayers with AGIs between $500,000 and $1 million. They only audited 1,400 returns with taxpayers with AGI over $10 million. So in terms of numbers of returns audited, 58% in this this is the sweet spot of the audits. 26% as you get a little higher, then 0.002%. And I'm sorry, this is 0.58%, 0.26%, not 58 or 26%. And then finally, if you're a really high income taxpayer, 0.001% is your chance of being audited. Finally, you can look at, just by comparing low income and high income taxpayers, if your AGI is less than $50,000, you have 6.2% chance of being audited. These are 60% of all audits, by the way. Taxpayers with AGIs below $50,000. If you have over $500,000, it's only 2.2% of audits, or 2.2% is audited, only 3% of all audits. So you are actually much more likely to be audited the less money you make. That's been a fundamental truth of our tax system for many years now. There's lots of reasons for that. The IRS, for example, heavily audits earned income tax returns, earned income credit tax returns, and those by definition are returns of the working poor, right? You have to essentially have a very low income in order to be entitled to the earned income credit. A very, very high percentage of those returns are audited. And then finally, one last chart I want to show you, just to give you an idea of what's going on, is the percentage of correspondence audits. And again, this is dated information, but I can tell you the trend has remained the same. The IRS really is moving away from field audits and office audits and towards correspondence audits. They're doing much more in terms of correspondence audits these days. So if you do get audited, chances are better than not that you'll get a correspondence audit. What about preventing an examination? Not getting audited in the first place, right? That's the best position to be in. Well, first of all, let me tell you about the statute of limitations. Although, as I said earlier, the IRS has 3 years from the date you file a return or the date, the due date of the return, whichever is later. They have 3 years to make an adjustment. Generally speaking, pursuant to their internal policy, they won't start an exam, they won't start an audit if they have less than 12 months remaining on the statute of limitations. Which means, and sort of going along with that, they want internally, their policy is they want exams to be completed within 26 months of the due date or the filing date. So what that means in realistic terms is 2018 audits are for the 2018 return, they want completed by June 15th of this year. All right. So if you have a 2018 return and it hasn't been audited yet, it's probably not going to be audited. The statute of limitation for 2017 returns runs on April 15th. All right, so that's just to give you a scope. So if you haven't been audited for 2017, 2018 at this point in time, chances are overwhelming. In fact, it's almost I can almost guarantee you that you won't be audited. 2019, 2020 is still, of course, open for audit. Note that you can object to repetitive audits. In order to legitimately object, however, 2 things have to be true. First of all, you have to have been examined within 2 years with no change, and the issues have to be the same. So in other words, the IRS is not allowed to just keep auditing you until they find something. If they've audited you within the last 2 years and it was the same issue, you can object and force them to stop the audit. Now that doesn't apply if you have a Schedule C, which is a sole proprietorship, or Schedule F, which is for farms. In terms of the current trends in audits, what are some of the things that make them suspicious when they do that classification? Too many round numbers, right? Your sales and your expenses all come to nice round numbers, right? That might draw their attention. The F bar, that's the foreign bank account reporting. Remember, if you have a foreign bank account, if it has $10,000 or more at any time during the year, you have to report that on a special report that's done online. Passive activities are something that they're weary of. I'm going to talk about that in a minute. Worker classification, I'll talk briefly about that at the end. Matching and COD income, meaning that COD income for cancellation of debt income. This is something that a lot of people don't realize. If you owe somebody money and they cancel your debt, that's income to you. And so when that happens, the IRS is often looking for that sort of thing. And then finally, preparer projects. Sometimes you're audited not because of anything on your return, but what the IRS will do sometimes is they identify a particular preparer, tax preparer, who seems to be doing things incorrectly, and they'll start a preparer project, which means they'll audit not all of that preparer's returns, but a lot of a very higher percentage of the returns that they prepare. One of the things that's interesting about that is that the IRS can't tell you why they're auditing you. So they're not allowed to say that they're auditing you because they're doing a preparer project. And one of the frustrating things that several revenue agents have told me is that, they'll be auditing somebody on a preparer project, and the taxpayer turns for advice to their preparer, and so oftentimes I'll have revenue agents tell me, I want to tell them, look, don't talk to the preparer. That's the one that's getting you audited, but they're not allowed to. So just be aware of that. Also be aware that, the burden of proof is always on the taxpayer. A lot of times my clients will say to me, well, I don't know, I don't have my records or something. Let the IRS prove I'm wrong. The IRS doesn't have to prove anything, all right? The burden of proof is on you. If you can't prove it under the law, the IRS is deemed to be correct, all right? So there are times when the burden shifts to the IRS, but it's very rare. In order for the burden of proof to shift to the IRS, you have to have met all of the substantiation requirements, meaning that you have given them all the documents that you should have had. You have to maintain appropriate records, and you have to have cooperated with the IRS. Well, the fact of the matter is, if you meet those 3 requirements, you're not going to have an issue, okay? But so the point of the fact of the matter is the burden of proof is basically always on the taxpayer. I haven't talked a lot about tax court, but that's, as I said, that's a place you can go and contest your tax liability before the assessment is made. Remember, you have to have that 90-day letter. The 90-day letter is your ticket to tax. You can't go to tax court until you get that 90-day letter. Once you get that 90-day letter, you have to file a petition within that 90 days. And if you fail to do so, then your chances of going to tax court are forever gone on that particular year. Let's talk about the psychological checklist for an audit. Here are some of the things that I think you should consider or be aware of. First of all, you should always treat the examiner with respect. As I said, sometimes taxpayers take the position that the tax auditor is out to get them, they're your enemy. They're not. I know and love several IRS employees, several people who are now or used to be tax examiners. They're just regular people like you and me. They just want to do their job. They don't, as I said, generally speaking, they don't care if there's an adjustment. If there's an adjustment, they want to find it because that's what their job is. But they're not out to get you. They don't really care. Once they're done with your audit, they'll never think about you again. You should always pre-audit the return. Now, that's really advice maybe more for representatives, CPAs, and lawyers, and enrolled agents. But certainly when I get a client who's being audited, the first thing I do is I basically audit the return myself to see what I would find. You always want to control the audit, right? That's where you get back to getting commitments from the auditor, making sure that in terms of timing and everything else, that everybody's on the same page. Never leave the examiner alone. As I mentioned, when I'm representing a taxpayer, I sit with the auditor during the audit. As a taxpayer, you may not be able to do that. Again, that's an advantage maybe of having a representative. You may not be able to take the day off or whatever to sit with the auditor and watch what they're doing. And the last thing I want to mention in this regard is very frequently, the IRS will ask you to sign a document that extends the statute of limitations so that they have more time to do the audit. And this is a very common question I get all the time from taxpayers as well as from CPAs who will call me and say, well, should we sign that? Should we agree to delay? The answer is if it serves your purpose, if it serves the taxpayer's purpose, then yes. Sometimes the auditor wants you to delay just because they've got a heavy caseload and they want to try to manage their caseload so they don't have to try to get through so many cases all at once. I generally don't agree to delay in that case, right? That's their problem. When I generally will agree to delay it is when we need time to gather more records, right? I have a client maybe that has records and they're in storage, or they're going to have to go and find them and put records together, and we need more time. And so in those situations, I'll agree to delay the statute. Remember also that just showing that you paid an expense is not enough. You've got to show that there was a business purpose for it. Probably the biggest mistake taxpayers make when they represent themselves, they say, hey, look, I've got a document here, receipt. It shows that I paid this amount. Well, showing that you paid it is only half the battle. You have to also show that there's a business reason for that particular expense. All right, a couple of common situations I just want to address briefly. Passive activity in real estate professional cases are big. I mentioned that earlier. Passive activities basically come in two forms. You either have a business where you don't have material participation, right? So if there's an operating business, either you materially participate, which makes it an active business for you, or it's a passive activity. Rental activities are automatically deemed to be passive. Now, having said that, we don't have time to get into it this morning, but there are lots of exceptions. So certain things that look like rental activities really aren't treated as rental activities. But if they are rental activities, they're automatically passive. And then you have the real estate professionals. Real estate professionals, basically, although they are renting real estate, their residential rental activity is treated as a business. And so with a real estate professional, you get into the material participation issue, because for any business, if you don't show material participation, it's passive. So just a few cases to give you a flavor for this. There was a boat charter business involved in a case a few years ago. It was deemed not to be a passive activity because one of the exceptions is if the rental is 7 days or less, it's not considered a passive activity. That was the case here. Normally you count your spouse's activity. In other words, on a joint return, both spouses can count their activity to determine whether or not there's material participation. In this case, they filed married separate returns. Well, you file married separate returns, you can't count both spouses' activity. Being a real estate broker is considered to be in the real estate business for real estate professional status, but being a mortgage broker is not. That was established by a case back in 2016. The type of work you do doesn't necessarily make you a real estate professional. This was a case from 2018 where a custom builder was not deemed to be a real estate professional, did not adequately substantiate their entitlement to that status. On the other hand, there are cases like this case where a dentist was deemed to be a real estate professional, right? So it's not the title you have or the type of work you're doing. There are certain requirements you have to meet, and you have to substantiate those requirements. Here's a case where you had a licensed real estate appraiser, and their real estate appraising work would have counted towards their real estate professional status, but they did work for a CPA firm as an employee. And you don't get to count your work as an employee unless you're a 5% or more owner. In this case, the real estate appraiser wasn't. And then again, even if you show an adequate amount of time in the real estate trades or businesses to be a real estate professional, you still have to document that you materially participate. There was one case which was a little bit unusual where no documentation was needed, but in that case, the taxpayer got lots of income from the rental activity. So obviously they must have been doing some work. They had no other help. Nobody else did any work in the rental activity. And they had no other means of income. So all of their income was coming from that. So under those facts, the court said, well, clearly they must be spending a substantial amount of time at the rental activities. But don't take that case too much to heart. Generally speaking, you have to substantiate your time. Another topic that comes up a lot is a hobby loss case. When you have an activity, right, it's either a business or it's a hobby. The reason that's important is if it's a hobby, you have to report all the income, but you don't get to deduct any expenses, right? So that's the reason you want your activity to be classified as a business, not as a hobby. The IRS is alert for this because the IRS thinks that there are a lot of taxpayers, frankly, probably rightfully so, who do things that they really don't do for, to earn money, but they don't want to pay tax on all the money they do earn, so they want to take the losses or take the deductions. And so the IRS very frequently audits them. The regulations have a list of factors. Again, we don't have the time to go through all the different factors, but these are the factors that the IRS looks at to determine whether or not you are in fact in the activity for profit. The one specific thing I do want to say about this is there's a statutory presumption. The presumption is if you've had profit 3 out of the last 5 years, or there's a special rule for activity 7 out of the last 7 years, then they assume you have a profit motive, right? The idea is that profits are hard to make, right? If you're in business, you know that profits don't come easily. You usually have to try to get profit. So if you've been getting profits in 3 out of the last 5 years, they'll assume that you're in fact in the activity for profit. One last thing I'll mention in this regard is there is an election to defer the determination, which means that you say, look, rather than deciding whether I'm a business or a hobby now, let's put that off for a few years. And you do that by filing this form 5213. It extends the statute of limitations so that the IRS, can examine you beyond when they otherwise could. Without getting into a lot of details, again, the main thing I want to tell you about that is that you just probably shouldn't do it. It's very seldom advantageous to the taxpayer to do this, very seldom. So some cases I just wanted to show you to give you a flavor of the types of things that come up. There was a cattle ranching case. Cattle ranching case, they had no separate bank accounts. They were self-educated, so they didn't have any special education in cattle ranching. They worked 3 or 4 days a week. The land had appreciated. They never generated a profit. They hadn't generated profit in any year. They had some previous success in other businesses. They had other income. There was no recreational element. In this case, the court found that it wasn't a hobby, that in fact this was a business, and they allowed losses. In another case, you had this woman who had actually been a performer, had made some records, some not very successful records. Basically, she got her money from a trust fund, and so she decided to start this music club. But the court found that she was basically doing that for pleasure, and therefore it was really just a hobby. She had no real intention to make any money from it, and therefore she could not take any losses. So the case involved a hair braid. Now here, she was really unduly optimistic about her ability to make a profit. But then some things happened that were beyond her control. This was back in 2008 with the financial crisis. She did try different advertising techniques. She kept separate books and records. And the court literally commented that, this is not an activity that really generates like a lot of pleasure. And so they found that it wasn't a hobby. In fact, it was a business, and losses were allowed. Lots of horse cases. These come up all the time. This was a horse trainer who basically stopped doing her horse training business because of I think she had an injury in this case. She closed the bank accounts. She still had a website, but the court said this was a hobby. And then in horse racing, there were lots of losses, but they were initial losses, and the court recognizes that, oftentimes businesses at the beginning don't make money. So it wasn't a hobby, and losses were allowed. And then the last one is a model airplane business. This is a business that somebody had inherited from their father. They didn't even really like model airplanes. So there was no question that they were doing this just, for fun. And so the court found that it was not a hobby. There's lots of other cases I could talk about. Again, because of time, we won't do that. What I do want to leave you with are some questions to anticipate. Again, we won't go over all of these. But if you have something that the IRS is questioning as to whether it's a business or a hobby, you want to look at things like, do you have a business plan? Do you have the background to make money in this type of business? Do you have specific advertising goals and things like that? Do you have a system of record keeping? Do you have standard books and records? Do you do advertising and promotion, things like that? Have you taken steps to improve profitability, right? So if you're losing money, have you tried to change that situation? And then finally, I want to talk about trust fund penalties. Trust fund penalties refer to the money you withhold from your employees' pay. If you don't deposit that, you can become personally liable for it. The IRS has been encouraged to take this more seriously in the direction of additional criminal referrals. You can actually go to jail for doing this. What do we mean by the trust fund amounts? Well, if you look at your employment tax debt, it comes basically in 3 flavors. There's what you withhold in tax from your employees, There's the FICA and the Social Security tax, and then there's any penalties and interest. The FICA and the Social Security tax is paid half by the employee and half by you. These things that are in yellow, meaning the employee's money, the withholding you do for the employee's tax, for the employee's from the employee's salary, and half of their FICA tax, that's their money. That's the amount that if you don't deposit it, you could be personally liable for that trust fund penalty, what we used to call 100% penalty, because you're liable for the whole thing. Cash intensive businesses, the IRS is aware of lots of possibilities for cheating here, right? Receipts can be skimmed before they're recorded, or you just remove stuff from the cash register, or you make disbursements that are just made up. Sometimes clients will ask me, well, how would the IRS know if I have unreported income? Well, they've got a lot of ways of doing it, right? One of the things they'll look at is your lifestyle. If you're only claiming $20,000 of income, but you're taking a vacation in the French Riviera every year, that's going to draw their suspicion, right? If you have a business and you're reporting losses year after year after year, that's going to draw their suspicion. Why are you continuing this business if you're losing money? The first thing an auditor will do is what's called a cash T. and they'll show basically, how much money has gone into your bank account and how much money has gone out. And if there seems to be a deficit of funds, they're going to ask, well, how are you living? Obviously, you must have money coming in from somewhere else. Liquid assets being increased despite low profits, debt balances decreasing or remaining low, gross profit margins lower than industry average. That might make them suspicious, or unusually low annual sales. All right, and then finally, last thing I'll mention is worker classification audits. Sometimes people are inclined to classify workers as independent contractors. That way you don't have to deal with withholding or their share of FICA tax. However, the problem is you don't get to just decide who's an independent contractor versus an employee. It's a facts and circumstances test. There are 20 factors that the IRS has identified that go into deciding whether somebody should be classified as an employee or as an independent contractor. It's an issue you should be alert to. If you have workers and you're classifying them as independent contractors because that's simply easier, it might be worth your time having someone like myself take a look at that and giving you a conclusion. They might be genuinely independent contractors, but if they should be classified as employees, then you might be opening yourself up to some potentially large liability. And it's personal liability, not liability just on the business. And so that's it. That was sort of a whirlwind tour through dealing with the IRS. Again, my name is Chuck Borek. I am an attorney at Elville and Associates, and as Jeff mentioned at the outset, I also run this company called the Borek Group, where I do continuing education for CPAs and lawyers. There's my email. You can reach me at Chuck at either elvilleassociates.com or Chuck at borekgroup.com. Either way will get to me. Thank you for your time and attention. I hope I've given you some information you didn't have before. And, I appreciate your questions. And if you have any other questions, feel free to contact me anytime.
Well, thank you, Chuck, as always, for your expertise, and very comprehensive as always. And I think this is something we could spend many hours on, and maybe we could revisit another time. I know we have you back every couple months or so, and look forward to having you back again soon. So thank you very much. So if you do have another question for Chuck, now would certainly be your time, as we are up past 12 o'clock. But please get that into me right now as I finish with my closing brief comments here. So what I'll do for you, as I always do for our Elville webinar series, is in my follow-up email to you, I will send a video of today's presentation if you wanted to reference anything that you may have missed. And we have a couple comments thanking you for your time today, Chuck. Really great presentation. Doesn't look like any other questions though, but we appreciate the thoughts, everybody. So I'll send out the video. I'll send the slides out again if you didn't receive them for some reason. And so I'll try to get that out by the end of today. Tomorrow at the very latest, I'll get everybody's CE in for any advisors that we have on as well today. I know that we have, looks like at least 6 or 7 that I see just by name alone. So also for our webinar series, just want to mention a couple that are coming up. This Thursday, we have with our senior principal here at the firm, Olivia Holcomb-Volke, Estate Planning for the Individual, which was a popular one back last fall. So we're going to revisit that one. On April 7th, we have a new topic, which is the impacts of hearing loss as we age. And we have that with Dr. Tyler Rupp, who's a clinical audiologist with the Chesapeake Hearing Centers, and great organization that we've developed a relationship with over the last couple months. It's been great to get to know them, and you're really going to get a lot out of that presentation. I know that I'm looking forward to it, and my mom's going to be on that one as well, so I need to do a good job for her as the moderator. So looking forward to that one. And last but not least, April 14th, Understanding Estate and Trust Administration, which is a quarterly webinar we host here at Elville and Associates, and one that is always very full with attendees. And that's going to be hosted by Stephen Elville, our managing principal here at Elville and Associates. So that's one that you want to come on if you haven't been on before. So please take a couple minutes to fill out our post-webinar feedback. That would be a really big help to us. We value all your comments and feedback, and we appreciate your time doing that. And also, any questions, use Chuck as a resource, please, with the information that he has here on the screen. And if you want to set a time with Chuck, the post-webinar feedback is also a good way to do that too. So we look forward to seeing you on the webinar series again soon, and hope you all have a great day. Thank you very much. Take care.
Thank you.